Welcome back to the channel. Well, the 2024 election is over and Donald Trump is back in the White House.
Yeah.
The big question on everyone's mind is, what does this mean for the stock market? We saw a huge initial surge.
Yeah.
The Dow Jones jumped over 1,200 points to a record high the day after the election, with the S&P 500 and NASDAQ seeing significant gains as well.
Right.
But is this just a knee-jerk reaction? Or is there something more substantial behind this market exuberance?
You know, the market's initial reaction is certainly interesting. While some might see it as just a sugar rush,
Yeah.
I think it reflects a deeper anticipation of how Trump's policies might actually play out.
Right.
If we look at the sectors that saw the most significant jumps, financials, energy, industrials,
Right.
it suggests that investors are betting on a pro-business environment
Okay.
with potential tax cuts, deregulation, and increased infrastructure spending.
Yeah.
We might even see a resurgence of those Trump bump stocks. That performed well during his first term.
Interesting. But are those gains sustainable? I mean, the market doesn't always get it right,
Right.
and there are concerns about potential downsides, especially when it comes to inflation.
Sure.
If Trump's policies lead to increased government spending
Yeah.
and potentially reignite trade tensions, wouldn't that fuel inflation?
That's the million-dollar question, isn't it? The potential for inflation is a real concern. If prices start rising too rapidly, the Federal Reserve might be forced to intervene by raising interest rates, which could actually put a damper on the market's enthusiasm.
Right.
It's like a delicate balancing act. How much stimulus can the economy handle before it starts overheating?
And that brings us to another interesting point.
Yeah.
Interest rates under Trump's first term were a bit of a roller coaster ride.
They were.
We saw those gradual rate hikes leading up to 2019, then a sudden reversal with 3 rate cuts, and then, of course, the pandemic hit, and rates plummeted to near zero.
Right.
It makes you wonder, what's the playbook this time around?
The interest rate situation during Trump's first term was certainly unique. You had those initial rate increases, then concerns about a global slowdown, and those trade wars with China spooked the Fed into cutting rates,
Yeah.
followed by that unprecedented drop to near zero during the pandemic. Trying to predict how interest rates will behave this time is a bit like predicting the weather.
Yeah.
There are so many variables at play, but one thing's for sure. The Fed's actions will have a ripple effect throughout the entire financial system.
So for someone looking at their portfolio right now, trying to figure out what to do in this new Trump era, what's the best approach? Should they ride this initial wave, or is it time to batten down the hatches?
Here's where things get really interesting for investors.
Okay.
If you're feeling bullish about Trump's potential impact on the market, there are definitely sectors poised to benefit. You mentioned financials, energy, industrials. Those are all areas where we could see significant growth. Infrastructure is another space to watch, as are companies focused on domestic manufacturing. But the key is to be strategic, not impulsive.
So you're saying don't just throw money at the market because it's feeling good right now.
Exactly.
I think that's an important message for a lot of people. It's easy to get caught up in the hype,
Yeah.
but we need to be smart about this.
It's crucial to think about your investment strategy holistically. Don't just chase the hottest stocks of the moment. Think about diversifying your portfolio across different sectors.
Okay.
Consider looking beyond the U.S. for opportunities in emerging markets, which might offer attractive growth potential. And remember that hedging against potential risks like inflation is crucial. Precious metals like gold and silver have historically been seen as safe havens during inflationary periods.
This is all great advice. But a lot of people, even experienced investors, can get overwhelmed when things are as uncertain as they are right now.
Yeah.
What are some concrete steps they can take to stay ahead of the curve and make sure they're making the right moves?
One of the most important things is to stay informed. Don't just rely on headlines and talking heads. Dig deeper into the research. Understand the nuances of Trump's policies and how they might affect different sectors and companies.
Right.
And don't be afraid to ask questions if you're working with a financial advisor. Have an open conversation about your concerns and goals. This is a time for collaboration, not going it alone.
And even though we're focusing on the U.S. market right now,
Yeah.
it's important to remember that this is a global economy. What happens in one part of the world can have a ripple effect everywhere else.
Absolutely. And that's another reason diversification is so crucial.
Yeah.
By investing in a mix of domestic and international assets, you can potentially mitigate some of the risks associated with any single country's political or economic climate.
So we've covered a lot of ground here. The initial market rally, potential risks like inflation, the interest rate puzzle, and the importance of diversification. But I think for a lot of people, the big question is still, where do we go from here? What does the future hold for the stock market under a Trump presidency?
Predicting the future is always a risky business, especially when it comes to the stock market. But what we can do is look for clues and patterns, analyze the data, and try to make informed decisions based on the information we have. And that's what we're doing here today.
That's a great way to put it. We're not fortune tellers, but we can use our knowledge and experience to guide our listeners through this new landscape.
Exactly. And remember, investing is a journey, not a destination. There will be ups and downs along the way. But by staying informed, diversifying your portfolio, and being adaptable, you can position yourself to weather whatever storms might come.
This has been a fantastic overview of what we can expect in this new era. But let's dig into some specific strategies and ideas for how listeners can navigate this market.
Absolutely. Let's start by talking about those sectors that are likely to benefit from Trump's policies. We've touched on them briefly, but let's break them down further and see what kind of opportunities they present.
Okay, let's unpack this. What are some of the specific sectors that investors should be watching closely?
Well, we've talked about financials, energy, and industrials. These are all sectors that tend to do well under Republican administrations, especially with the prospect of deregulation and tax cuts. But within those broad categories, there are some specific areas that are particularly interesting.
Here's where it gets really interesting. Can you give us some examples?
Sure, within financials, banks and financial institutions stand to benefit from potentially higher interest rates and a less stringent regulatory environment. In the energy sector, traditional oil and gas companies might see a resurgence, with a renewed focus on domestic energy production. And within industrials, we could see growth in companies involved in infrastructure projects, manufacturing, and defense.
So what does this all mean for our listeners who are trying to make sense of their portfolios? What specific actions can they take based on this information?
Well, one approach is to look for individual stocks within these sectors that are well positioned to benefit from the potential policy changes. For example, if you're bullish on infrastructure spending, you might consider investing in companies that manufacture construction equipment or provide engineering and consulting services. Or if you think banks will thrive in this environment, you might look at specific banks that have a strong track record of lending to businesses.
But what about investors who are a little more risk averse? Are there any safer bets in this market?
Absolutely. There are always ways to balance risk and reward. One option is to invest in exchange-traded funds, ETFs. That tracks specific sectors. This allows you to diversify your exposure without having to pick individual stocks.
That's a great point. ETFs can be a really helpful tool for investors who want to gain exposure to a particular sector without having to do a ton of research on individual companies.
Exactly. And they can also help mitigate some of the volatility that can come with individual stock picking.
This is all great information. But let's not forget about the potential downsides. We've talked about inflation. But what are some other risks that investors need to be aware of?
One potential risk is that Trump's policies don't actually deliver the economic boost that the market is expecting. If his tax cuts fail to stimulate growth, or if his trade policies backfire, it could lead to a market correction. And of course, there's always the possibility of unforeseen events, like geopolitical crises or natural disasters, that could disrupt the market.
So it's not all sunshine and roses. There are definitely some potential pitfalls to be aware of.
Exactly, but that's why it's so important to stay informed. Diversify your portfolio and have a long-term perspective. Investing is a marathon, not a sprint.
I think that's a great place to wrap up this part of our conversation. We've covered a lot of ground, but there's still so much more to explore.
Absolutely. Let's shift gears a bit and talk about hedging.
Okay.
It's a word you hear a lot in investing. But what does it actually mean in this context? Essentially, it's about protecting your portfolio from potential losses. Think of it as an insurance policy for your investments.
Okay, that makes sense. So if we're worried about inflation eroding the value of our investments, what are some effective hedging strategies?
One classic hedge against inflation is investing in precious metals like gold and silver. These assets tend to hold their value, or even increase in value when inflation rises. Commodities like oil and natural gas can also act as inflation hedges, particularly if there's an emphasis on domestic production, as we might see under a Trump administration.
Those are some interesting ideas. But what about people who aren't comfortable investing directly in commodities? Are there other ways to hedge against inflation?
Absolutely. You could consider adding inflation-protected bonds to your portfolio. These bonds are designed to adjust their principal value based on inflation, so your investment keeps pace with rising prices. Another option is to invest in real estate. Historically, real estate has been a good hedge against inflation, as property values tend to rise along with the general price level.
So we've got precious metals, commodities, inflation-protected bonds, and real estate. Those are all good options for hedging against inflation. But what about the other side of the coin? What if Trump's policies actually spark a period of rapid economic growth? Wouldn't we want to be positioned to benefit from that?
That's where those growth sectors we talked about earlier come into play.
Right.
Financials, industrials, energy, those are all areas that could see significant gains if the economy takes off. But it's not just about picking the right sectors, it's also about understanding the global landscape.
You're talking about diversification again, right?
Yeah.
But specifically, what should we be looking at outside of the U.S.?
Emerging markets could offer some compelling opportunities. These are countries with rapidly developing economies that often have higher growth potential than developed markets. Think of countries like India, China, Brazil, and Indonesia. While investing in emerging markets comes with its own set of risks, the potential rewards can be significant.
This all makes sense, but I think a lot of listeners are probably wondering, how do I put this all together? How do I create a portfolio that balances growth potential with risk management and hedges against inflation?
That's where it gets really interesting. Think of yourself as a financial architect. You're building a portfolio that's designed to withstand different economic conditions. You've got your foundation, which might be a mix of high-quality stocks and bonds. Then you add your walls, your growth sectors, like financials and industrials. And then you put on the roof your inflation hedges, like precious metals and real estate.
That's a great analogy. It's like building a house that can weather any storm. But building a portfolio is one thing, managing it is another. What are some key things to keep in mind as we navigate this new market environment?
One of the most important things is to stay flexible. Don't be afraid to adjust your strategy as the situation unfolds.
Okay.
If inflation starts to heat up, you might want to increase your exposure to inflation hedges. If the economy shows signs of slowing down, you might want to shift some of your assets to more defensive sectors like consumer staples or healthcare.
And speaking of staying flexible,
Mm-hmm.
what about holding some cash? Is that a good idea in this environment?
Holding some cash can be a smart move. It gives you the flexibility to jump on opportunities if the market takes a dip. It's like having dry powder ready to deploy when the time is right.
That's a great way to put it. So we've talked about diversifying across sectors, looking for opportunities in emerging markets, hedging against inflation, and holding some cash. Are there any other investment strategies that might be worth exploring?
Absolutely. There's a whole world of alternative investments out there. Beyond the traditional stocks and bonds, real estate, as we mentioned, can be a good hedge against inflation. Infrastructure funds can offer exposure to large-scale projects like transportation and energy. And then there's the world of cryptocurrencies, which, while highly volatile, could offer significant growth potential.
Cryptocurrencies. Now, that's a topic we could spend a whole episode talking about. But for now, let's focus on what our listeners need to know to make smart decisions about their portfolios in this new Trump era. What's the key takeaway here?
The key takeaway is that there's no one-size-fits-all approach to investing. The best strategy for you will depend on your individual circumstances, risk tolerance, and financial goals.
So it's about tailoring your portfolio to your specific needs and aspirations.
Right.
But even with a tailored approach, there's still a lot of uncertainty in the market right now. How can investors stay ahead of the curve and make sure they're making informed decisions?
The most important thing is to stay informed. Read financial news, listen to podcasts like this one, and talk to your financial advisor. And don't be afraid to ask questions. The more you understand about the market and the forces that drive it, the better equipped you'll be to make sound investment decisions.
That's excellent advice. But staying informed can be overwhelming.
Sure.
There's so much information out there. And it's not always easy to know what to focus on. What are some key things that investors should be watching closely in the coming months and years?
Here's what I would be paying attention to. How Trump's policies actually play out in practice, how the Federal Reserve responds to those policies, and how the global economy reacts to this new era of American leadership.
Those are all crucial factors to keep an eye on. And speaking of the Federal Reserve, they're kind of the wild card in all of this, aren't they?
Absolutely. The Fed has a lot of power to influence the economy and the markets through its control of interest rates. If they raise rates too quickly, it could stifle economic growth. If they keep rates too low for too long, it could lead to runaway inflation. It's a delicate balancing act.
So for investors, it's about understanding the potential impact of the Fed's decisions and positioning their portfolios accordingly.
Exactly, and that's why it's so important to have a diversified portfolio that can withstand different economic scenarios. You want to be prepared for whatever the Fed throws your way.
This has been an incredibly insightful conversation. You've given our listeners a lot to think about. But before we wrap up, I want to go back to something you said earlier about staying informed. What are some specific resources that you would recommend to investors who want to deepen their understanding of the market?
There are so many great resources available these days. For staying up to date on financial news, I recommend reputable sources like the Wall Street Journal, the Financial Times, and Bloomberg. For deeper analysis and commentary, I suggest subscribing to newsletters and podcasts from respected financial analysts and economists.
And of course, there are books, blogs, and online courses that can provide a more in-depth understanding of investing principles and strategies.
Exactly. There's a wealth of knowledge out there, both free and paid. The key is to find resources that align with your learning style and investment goals. One more thing I think we should touch on that often gets overlooked is the psychology of it all.
Oh, yeah.
Investing isn't just about numbers and charts.
Right.
It's also about understanding human behavior
Uh-huh.
and how our emotions can influence our decisions.
That's so true. We've all heard about people making impulsive investment decisions based on fear or greed.
Yeah,
It's like a market can become this emotional roller coaster.
right.
How can investors avoid getting caught up in those swings and make rational decisions?
Well, one of the best ways to combat emotional investing is to have a clear investment plan and stick to it.
Okay.
Write down your goals, your risk tolerance, your investment strategy.
Mm.
And when the market gets volatile, refer back to that plan. It can help you stay grounded and avoid making decisions based on fear or panic.
Yeah, having that plan in place is like having an anchor in a storm.
Exactly.
It can help you stay on course even when the waves are crashing all around you.
And remember, the market is always going to have its ups and downs. That's just the nature of the beast.
Sure.
The key is to ride those waves without letting them capsize your boat.
So much easier said than done, though, right?
Yeah.
I think for a lot of people out there, the big question is still, is now a good time to invest? With all this uncertainty surrounding a Trump presidency, is it better to wait and see how things play out? Or should we be jumping in head first?
That's a question that only you can answer, based on your individual circumstances and your risk appetite. But here's what I would say. Time in the market is often more important than timing the market. Trying to perfectly time the market is notoriously difficult, even for very experienced investors.
So you're saying it's better to be consistently invested, even if that means riding out some volatility, than to try and pick the perfect moment to get in or out.
Exactly. And remember, investing is a long game. We're not talking about making a quick buck here.
Right.
We're talking about building wealth over time through a combination of smart investments and disciplined savings habits.
This has been an incredibly insightful conversation. We've covered a lot of ground, from the initial market reaction to Trump's victory to specific investment strategies and the importance of managing our emotions. But I think the biggest takeaway for me is that there's no one right way to invest.
Right.
It's about finding an approach that works for you, your goals, and your risk tolerance.
I couldn't agree more. Investing is a personal journey, and there is no magic formula for success. But by staying informed, seeking out expert advice, and being willing to learn and adapt, you can increase your chances of reaching your financial goals.
That's a great message to end on. Thanks so much for joining us today. It's been a pleasure talking to you.
The pleasure was all mine. Thanks for having me.
And to all of our listeners out there, thanks for tuning in. We'll be back next week with another deep dive into the world of finance and investing. Until then, stay informed, stay invested, and stay well.